Today's focus is the 2.0 version of the Tesla Destroys the S&P that we started in our last show. So, by the way, today I'm in front of E-Trade. I'm in Atlanta, Georgia. We're at a place called Lenox Mall. You'll also notice my hat, which is blocking my mic because we want decent sound and my wind baffle isn't handy. So thank you for your indulgence. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters, and also want to thank those of you who choose to like and subscribe so that we can be able to have the resources to present our show. I also want to thank you guys because there's a donut place here that I get to visit thanks to you, because they're always closed, and now I see the coffee sign blinking. So thanks for adding to my calories today. At any rate, one of the problems we ran into in our last show was we were looking at something that's called Tesla Destroys the S&P, and the question was, how and why does this process work? So one of the challenges that I have with that show, and everybody has as a challenge, is what I've talked about before, something called the bell curve, which is if you look at a bell, on one end of the curve, what you're saying is too slow for a part of your audience, and it's very, very fast for another part of your audience, so you're stuck trying to find that middle. What we found in this show is we had more comments regarding, I should understand what you're saying, but I kind of don't. Can you provide links to what you're talking about? So today's show is going to be kind of two parts. Part one is sort of a background on what we were talking about in some of the industries that we covered last time. Part two is going to be more intense, and for those of you who are sort of professionals in the field or extensive experience, so we think that's about the 10-minute mark. So I'd encourage you to kind of skip to that and not be bored by the basics that I have to cover right now for the obvious reasons. So the first part I would like to cover is sort of an evolution of money management. What's happened since the 50s, so before, let's say 65, you had a situation where all investments were in the trust departments of large institutions. And so what this resulted in is that, like in the bank, you'd have a trust department, they handled investments, it was a done deal. So that process changed as, I guess, the government rules changed, and all of a sudden you had the start of brokers of different types exclusively handling investments outside of what was inside the bank normally. And then that evolved into what's called discount brokers, so different ways for people to differentiate themselves. As you'll notice behind me, I'm in front of the E-Trade office, which is appropriate. They don't sponsor us. I do trade with them, but they're an illustration. Funny thing about E-Trade, though, and we've talked about this for a while, is the fact that E-Trade was a freestanding company, and then it was actually bought by Morgan Stanley. So we've been talking about brokers like this selling their inventory or their order flow to the big firms. And in the case of Ameritrade with Charles Schwab and E-Trade with Morgan Stanley, these guys have been purchased and are now part of these larger institutions. So it's not clear to me how their fund flow is working between the two firms, but it is an interesting note. So one of the things that's so that's number one. Number two, there's a trend that developed, let's call it starting the beginning of the 70s, where initially people started investing in stocks individually, for example, like Tesla. What happened is that there are some folks who made great money, and there are other people who got completely destroyed as those companies went bankrupt. And one would think that the driver for this was the fact that there are a lot of companies that allow you to invest your own retirement funds in the company, and there are a lot of people who got blown away by this. Examples might be a Xerox or a Kodak, Eastman Kodak, or the long list of companies that were huge in the 60s that became non-existent or very weak by the late 70s or early 80s. So there was a transition that occurred in this time period from encouraging people to invest and therefore directly into stocks into a concept called a mutual fund. And all a mutual fund is, a whole bunch of stocks are put into a fund, and if any one of those stocks goes bad, you're fine because your fund includes portions of stock from a number of companies. So it was not only a safety measure, but it was also a way to reduce the headaches of you having to track everything happen with the one firm you might have your money in. So I've already stated it. Yes, you're investing in Tesla is a good idea, and obviously the goal is for them to not go out of business and you lose your money, but that's one of the reasons why our funds were started. So basically what happened is these funds did fine, made good money for investors for a while. Fidelity emerged and was the largest for a long time, and other firms sort of competed and delivered products that were competitive, and therefore you have all these mutual funds sitting out there. So then this issue popped up, which is, now wait a second, if you're a mutual fund, why should we bother messing with you guys if your fees are so high that you're sucking up a lot of my return? So the answer that came up was, and I believe John Bogle was the leader of this, and they lead in terms of the number of funds that have the S&P index in particular. So all these indexes emerged. So for example, you have something called the NASDAQ 100 index. The largest companies in the NASDAQ would be that fund. And people like to focus on a fund like that because most of the growth in the economy is focused on entities like the NASDAQ, where Apple resides, and think of all the big tech, Google, Tesla, all these names are in there. And so people created these funds and everything was happy because now you had all these ways to invest. You did not have to risk yourself completely with one stock, and you could focus on different sectors of the market. So for example, there are bond funds where they focus on certain types of bond, be it corporate bonds or government bonds. There are currency funds. There are funds focused on stocks. So one of the things we covered last time was, let's look at something called a large cap fund or large capitalization fund, or there's a term called a mid-cap fund, which is middle capitalization, kind of around $1 billion to $3 or $4 billion in market cap. And then there's something called a small cap fund, and that could be, let's say, $1 billion or below. And then we can get into what's called micro cap, which is companies that are maybe 500 million or below in market cap. And so there are all these funds out there in the universe. So what started happening is people started getting confused. They're like, I want to invest, I want to put my money to work, I don't want to lose it, I want to make some money. So where can I put my money that's low fee, but good money managers that will do a good job and I don't lose all my money? So when you add up all those parameters, that's how you come up with something called the S&P. So the Standard & Poor's 500 is the 500 largest market capitalization companies in the United States. So with this new fund, the process was a little different than others in that there's a concept called balancing. So basically, if you're a fund manager that's operating with the parameters of how S&P operates, they tell you, hey, you need all this list of companies, and based on market cap, you have to do a balancing process of what you own in your fund relative to the process that we've described. So we now have an interesting problem, which is anytime you add a company to the 500, you have to delete a company. I'm told Hewlett-Packard would be the company that would be deleted once Tesla gets in. So what's fascinating about this is that there are a myriad of rules about how the balancing process works, and it happens quarterly. So one of the sidebar notes here on Tesla that we've been focused on is there's a problem going on, which is we thought that Tesla was S&P was watching Tesla and give it a week or two, and they'd be entered in the S&P, and the spike in Tesla's stock price reflected that logic, and I frankly believed it myself. But after doing some research, I just read a Fortune article where they delineated the fact that there are monthly meetings of the S&P to figure out what they're going to do, but the actual next rebalancing isn't until the 21st of September. So in theory, you want to add Tesla, do a rebalance, and now you have the S&P in its new iteration. Another thing that I saw that wasn't germane to that article was just the idea of the S&P needs to protect itself. So if it doesn't have the top 500 companies, it's even violating its own rules because those 500 companies are not in. So I don't think with Tesla's fourth quarter profitability, there's any question about them being in. It's just a matter of how this balancing process is going to work with them. The other, so by the way, the balancing process being quarterly answers the issue of how do you handle Tesla accelerating in value within the S&P as it enters the S&P, and the answer is you simply wait a quarter or 90 days before you do the rebalancing again. So that addresses that issue. So, a little noisy here. So what I wanted to review next is the fact that we have this situation happening now where we have these mutual funds. And so the question is, why did people go to S&P? The answer is that there are these companies where they all of a sudden have thousands of funds that have been opened, and people started getting confused about which fund should I choose and why? And how do I check up on the performance of this fund? So there are all these questions. That's where John Bogle and his huge S&P fund came in, because his fees are like 0.25%, or somewhere like between 0.5% or less of the money that you invest. So he basically destroyed everybody in terms of people who wanted to charge more to help you invest in the S&P. And the reason is largely there's a computer-driven process where they actually put together the S&P. For some reason my screen is dark. Hopefully you guys can see me still. So what's happening right now then is we're in a situation where probably half of the index funds out there are in the S&P, and John Bogle, because of his fees, probably has, maybe even half of that money that's out there. And so the challenge right now for them is, how do you deal with Tesla with a myriad of issues? Usually you don't have a large cap company like that, or a large capitalization company like Tesla entering the S&P. What do you do with that? How do you rebalance other entities within the S&P to this? So the issue is that there's a lot of math going on and some guesswork. And as a result, you have what I think is not a confused S&P, because you can just let the computers run and they can spit out the numbers. The key to it is you have to do process against that computer ability to look at the numbers. So I'm bringing all this up to you because today we're in the interesting, what do we do with Tesla zone? And the answer that's coming up is, we don't know, and even they don't know. So the next part of my intro part that seems to be ending up as being our complete show for the day is, there's a guy named Peter Lynch who used to run Fidelity funds. He built it up from nothing, $10 million, to the largest $100 billion fund, investment fund in the world with great returns. And a lot of people try to match him and weren't able to. That's part of the reason why these index funds took over. And so now we have an interesting problem, which is, I want you guys to all read a book called One Up on Wall Street. It is considered the Bible of the industry. So I don't want to overstay my welcome on this show, and we'll be doing a couple of others that circle around the S&P that you'll hear from us. But number one, I want to ask you to read Peter Lynch's book, One Up on Wall Street. Even if you read the wiki page 3 or 4 times, the knowledge you'll gain is phenomenal. I kind of go through it all the time because the core logic is fantastic. The other thing I wanted to mention I thought was interesting that affected my show today is I was going to be very sneaky about how I was going to win the discussion of having great comments to make to you guys. And that was, I called up a buddy of mine who, after business school for the last 20 years, has been at T. Rowe Price. And he's one of the most senior people there based on tenure, and he has a Stanford MBA. And I was thinking, no problem, I just call him up. He knows the drill in terms of mutual funds because that's what they are, that's what they focus on. They have $1 trillion under management. Even though he doesn't work necessarily on S&P, he's still in the house and understands what it is, what it does. And his response to me was, wow, I know nothing about what's going to happen there and why. Let me check around and get back to you. So that'll be one of the items that we'll be getting back to you guys on. And so I was thinking, man, I can't believe for such a big issue, somebody at that level wasn't intimate with it, even casually, even though he focuses on bonds. And this also brought up the issue of what Tesla's up to is so rare relative to the S&P that even people that are experts in the industry and have been in it for 20 years at the highest level at big funds don't know the process well because it's a specialized niche. So I kind of bring this up because I don't look as bad if somebody that's been at one of the biggest firms in the world and should be casually knowledgeable of it has these issues, because it's like, oh, okay, this is complex, this is different, it's unique, and it takes a lens that's different to understand what's occurring. So I want to shut down at a reasonable time for this show today by saying that we have a couple of shows planned, one of them with an investment banker whose thesis is that a lot of what's going on with Tesla coming up is kind of like an IPO. And that's our next show. His name is Wayne Green. I think you'll enjoy what he adds to the conversation. So I wanted to note that it's still my belief that right now the problem with Tesla is that it's kind of at the apex of what they've done in terms of valuation from just the operations of the company. And they're sort of slightly still beyond where they should be if it wasn't for the overhang of the move to the S&P. So I really think if you're heavy in Tesla, be aware that this is a tough zone to be trading, because we don't have the catalyst to push the stock price up. And it seems like the only people that are winning the day right now are the analysts who downgrade the stock and therefore have the stock price falling. At any rate, we look forward to continuing this discussion. We didn't get to our more complex part B, but I'm looking forward to getting responses on our page that articulate people learn some things here and fielding questions on the structure of the investment industry, etc. The index funds, S&P in particular, has been great. A lot of people have made great money as they've gotten into it, and I think you would as well. At any rate, thank you for joining us. We do have a couple more shows to go, and thanks for joining us. Remember to like and subscribe. This is Greg for Teslafaninsight. Tschüss, macht's gut, au revoir, lehitraot, khoda hafez, assalamu alaikum, hey do, zdravstvuyte, ni hao ma, and in Jamaica we say, enough respect, walk good man. Have a great day, bye for now, and we don't want the show to go crazy long, but we do have more to cover here, and I think you'll enjoy the coverage.